You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with Indian markets. Markets continue to remain under pressure today, with both benchmark falling over 0.5% in today's trading day. With me in the studio are my colleagues Krishna Kumar and Suyash. Suyash, let's quickly take a update from you as to how markets closed this afternoon.
So, Shweta, after, fighting off that profit booking for the two consecutive sessions, Indian markets finally witnessed a crash today. Both Nifty and Sensex fell about 0.5% on weak global cues. The biggest overhang for the market was the minutes of the US Federal Reserve's July monetary policy meeting, which hinted that there is a possibility of further rate hikes to tame the sticky inflation. Now, Nifty ended 0.51% lower at 19,365 mark. It has still managed to defend that crucial support of 19,300, which is a good news for the investors. Sensex was down 0.58% at 65,157 levels. Mid cap and the small cap index saw some buying interest today. Mid-cap 100 index was up about 0.25% at 37,895 points, and small-cap index was up 0.14% at 11,745 levels.
All right. Also joining us on the show at this point is Kranti Bhuttini, who's a markets expert. Kranti, good to have you back. Explain to us what's happening in the markets today. Weak global cues not just hurting all Asian indices, but also having a solid impact there on Indian markets.
Yes, Shweta, definitely the global cues are impacting the markets on a negative side, and markets have been drifting down at this point of time. We can call this as a kind of a consolidation on Indian markets after RBI monetary policy and as your colleague rightly mentioned about the Federal Reserve Open Market Committee minutes, that we are ready for a next couple of rate hikes, but it's completely premature to say because Federal Reserve have a tendency to change their stance at any point of time. But it seems to be, as per the current data what we available, and also the minutes of the meeting is reflecting that probably we are heading for a couple of rate hikes, and also the Bank of England and other central banks, they are taking a collective synchronized global liquidity tightening. That's what we are expecting at this point of time. And also from the discussion and the outcome of India's monetary policy is concerned, probably the markets were expecting a rate cut probably in December. That's taking delay. Probably we don't expect a rate cut during this financial year. That's the reason markets are right now going through a kind of a consolidation phase right now. But what we see in these markets is there is a complete leadership rotation, and sometimes today, if you see, the mid and small caps are quite resilient despite of the headline indices drifting down.
Kranti, we have talked about this time and again that for Nifty, 19,300 has emerged as a crucial support over the past couple of weeks. So, do you expect that a fall below that level could trigger a sell-off of 500 or 600 points?
It can be possible as per the market tendency is concerned, because it's always said markets in short term are voting machines. So, if the sell-off further comes, it can drift it down. But we need to consider the fact there is a heightened buying activity that's taking place from the domestic institutional investors, and also retail investors also very active, and here and there the foreign portfolio investors have been buying regularly in Indian markets. They have been adding the further support to the market. So I don't think so there is a imminent correction in the market immediately. Markets have been quite resilient. If you see some days what we are witnessing is some kind of buying interest has been emerging in the lows of the day. So overall, we need to wait and watch how the market is going to hold the 19,000 level. So it is premature to say, but crossed our fingers how the things are going to pan out. But one thing is clear, whenever there is a drift down in Indian markets, whenever there is a correction in Indian markets, if we go with the numbers and data, every dip on Indian markets, it's a very good buying opportunities for the investors rather than scared about with the corrections in the market. Better to participate and take part in these kind of corrections for the investors.
All right,
But
Kranti. Yes. Suresh.
but where to put money, because headliners have been under pressure. Nifty and Sensex have been under pressure for the past couple of months, and mid cap and small cap indices have given gains. But will it be safe to invest in the broader markets as opposed to blue chip companies at this point?
It all depends upon the risk appetite of the investors. If you see last couple of days, the defense PSUs and the stocks in defense, even the private sector defense companies also, they have been performing extremely good because of the visibility in their order book and the new orders they have been gaining in these kind of markets. One way markets are drifting down, but whereas the defense stocks have been outperforming. And some days what we witnessed is PSU banks outperformed during the week. So investors need to see what kind of positional trading they are taking place. So accordingly, there are some opportunities emerging in this market. So investors need to consider those kind of opportunities because it's more stock specific rather than the sectorial segment specific.
All right, let's also quickly take a look at the top sectors and what sort of trends they showed today, this afternoon. If you could run us through some of these top gainers and losers at this point.
Yes, Shweta, definitely. So most sectors were under pressure today. As Kranti pointed out, PSU stocks have been a favorite at least in this downturn, and Nifty PSU Bank once again emerged as a winner in that line. It was up about 0.87%. Banking stocks have been under pressure. Nifty Bank was down about 0.18%, while Private Bank was down about 0.24%. Now FMCG, auto, IT sector, all sectors ended in the negative territory today. Now if we are talking about individual stocks, Shweta, Adani Group stocks were able to buck trend, and Adani Twins in the Nifty pack were actually among the top gainers today. Adani Enterprises was up 1.42% and Adani Ports was up about 4.32%. Now this is the returns of all 10 Adani Group stocks which we have seen. Most of them ended today's session in the positive. Among the top gainers was also as mentioned, Adani Ports. We have other 5 companies which also include Ambuja Cements. Right. Now, among top gainers, Adani Ports as Adani Enterprises also obviously feature. Titan, Axis Bank and Bajaj Consumers also posted solid gains for investors today. Now, among losers was ITC, which was down about 2%. Power Grid Corporation, which was down about 1.85%, DV's Lab, which was down 1.66%, and Larsen & Toubro, which fell about 1.53%.
All right, let's quickly take our viewers through, these numbers, interesting numbers there. Let's crunch them further down to Adani first. Since you mentioned all 10 listed companies made profit, there was a gain, of course, in the share prices, and all of that on the back of the big news that is coming in as far as the GQG investment in concern. GQG's latest investment in Adani Power means that the total investment that the firm has made so far in the Adani Group totals to about $4 billion.
Yes. So if we are excluding their what they bought from the promoters, it's about 25,000 crores. But if we also add Ambuja Cements, which they have been buying in the open market, which adds about another 50 to 60,000 crores, so we get a figure of $4.2 billion.
$4.2 billion.
Now, GQG has been consistently buying Adani stocks, right? This is Adani Power is the 5th company in which GQG has invested their money. Now they have also acquired a 6.54% stake in Adani Enterprises, about a 5.4% stake. About a 5.4% stake in Adani Enterprises, about a 6.54% stake in Adani Green, about a 2.5% in Adani Transmission. So since that Hindenburg collapse started, slowly and steadily GQG has been raising its exposure in Adani stocks, and not only Adani stocks, Indian portfolio, the country-wise allocation in GQG's $100 billion portfolio, India's allocation is about 33.5%. It also has ITC and SGFC Bank in its portfolio. So apart from Adani, GQG is also betting big on India.
GQG betting big on India apart from Adani, of course. Let's quickly get in Kranti into this conversation. Kranti, I think investors are positively taking to GQG's investment in Adani. As you can see from all that performance there for all companies, not just Tata, not just Adani Power. Adani Power was up almost about 2%, but all the other listed companies, of course, also in the positive terrain, bucking the trend. Where we see a sea of red, we see Adani Group bucking that trend.
Yeah, Shweta, GQG have been giving the confidence booster for Adani Group from past couple of months time. So they are quite bullish about the prospects and infrastructure business in India, and they have been the continuous buyers starting from Adani Enterprises, Transmission, and now with respect to the billion-dollar buy with respect to Adani Power is concerned. So they are quite positive with respect to fundamentals and prospects of Adani Group is concerned. It's good for Adani Group also to gather around 4.2 billion. It translates around 37,000 crores, which they have comfortable liquidity in their hand to meet the bond obligations that are going to come. So it is a win-win situation for both, and this led the retail also take confidence, and also some other sovereign funds like Qatar Investment Fund. They also have been investing in Adani Group, and also the retail participation also going up right now. But these stocks are suitable for the high risk appetite investors than the normal regular retail investors are concerned. So one need to check their risk appetite while taking any investment decision in this group.
So actually, Shweta, if you look at since the Hindenburg report came out, Adani stocks have rallied, they have bounced back, but they are still trading way below the prices that they were before that Hindenburg report came out. Now, several stocks of the company are in the red. I think Adani Ports is the only one which is up from the January 24th price. It's up about 4%. Most stocks, Adani Enterprises is down almost 30%, Transmission is down almost 80%, Green is down almost 50%. So even though the concerns, it seemed, had taken the concerns raised by Hindenburg had taken the back seat in the last couple of months, but the stock has not recovered. So maybe there is an opportunity. As you can see, Enterprise we were talking about down 28%, Transmission is down 70%, Total Gas 83%. Adani Ports and Adani Power are the only two stocks that are above that January 24 price levels. So it shows that if the clean chit comes from SEBI and status quo is maintained, there is a plenty buying opportunity. Kranti, what do you think about that?
Yeah, so Yash, it seems to be the stocks are available from their peaks at a very discounted prices, but there are overhang, as rightly mentioned. The SEBI has asked for another 15 days time to submit the report about the Adani Group. So there is a overhang. So the investors have been waiting for this report, how it's going to be. But as I mentioned earlier also, there are some kind of strong infra businesses are available like Adani Transmission. These stocks have corrected from their peaks of around 4,000 level, and Adani Transmission touched a level of 665. Currently, the stock is around 820 to 25 levels. The stock has been hovering. So investors with high risk appetite only, they can choose these stocks, because with the conventional wisdom and the matrix what available for the normal valuing a company. So the stocks, most of the stocks don't fit into that criteria. It's the PE levels are very high for these stocks still after the so much correction in these stocks. So one need to take into cognizance of their risk appetite while taking any serious investment decisions in Adani Group shares are concerned.
All right, Kranti, stay with us. Another interesting story that we're tracking is coming by the way of Bata at this point in time. Bata India surged over 5% today on the back of a possible tie-up with Adidas. Those, of course, are reports. Suyash, what's happening? Are we going to get Bata shoes with Adidas logo or Adidas shoes with Bata logo? What's going to happen here?
I mean, that seems to be the case, and investors are definitely buying into that reports, because the stock on an intraday basis it rallied about 6% and it closed about 5% higher. Now the report is that Bata India and Adidas are in advanced stage of talks for a strategic tie-up for the India business. Now we also need to understand that Bata has been diversifying its portfolio over the last few quarters. Now the company primarily catered to brand conscious clientele, but over the last few quarters it has increased its stake in the premium segment also, as it was mentioned by the management in the earnings con call of June quarter, that market share in the premium segment has increased significantly. So it is good for the investors, because Bata, being such a household name and has a very good brand reputation, is also diversifying into the premium segment.
Premium segment, absolutely. Bata, they're diversifying into the premium segment that so far has not been a target market for Bata. Kranti, this augurs well for Bata, as well as for perhaps Adidas, which can now look at having more customer base in India through Bata.
Shweta, you are absolutely correct. The news has been propped up today, and the exchanges have asked for a clarification from Bata management, from the company, to give a clarification on the news that it surfaced today. So we need to wait and watch what the reply that comes from Bata. But Bata has been doing pretty good in terms of the sales is concerned. If the tie-up going to finalize, it's going to add the sportswear brand where Bata is lacking, and Bata is known for more about the traditional, conventional wear, whereas from Adidas tie-up, okay, it will add their premium products like the sportswear where the high margin business is concerned. But Bata has been doing, they have been increased their visibility, changed the brand model, and also increased the number of franchises in past 4 or 5 quarters. So it's a decent stock to be in the investors' portfolio. If the investors are having the stock in their portfolio, they can continue to hold on to the stock at this point of time.
All right, Krishna, this is moving away from the story about stock, which is clearly up about 5.6%. It's a good story for a lot of consumers in India, for a lot of people who are keen on buying Adidas footwear, cannot afford it because it's way too expensive. Perhaps the price point will likely decrease now. If Bata and Adidas are to come together, they have to come up with a product that is doable for both of them, for both of their target consumers and their target market. So perhaps a lower price point, a more affordable sports shoe, is that something we're looking at?
To be really honest, the reports right now are very sketchy.
Okay.
There are exactly 2 sentences that it says. That says that they are exploring a partnership, a strategic partnership in India.
Okay.
And that the deal contours are in the final stages of being finalized. That's all we know. It's a strategic partnership for Adidas in India, and the deal contours in the final stages of being finalized. Now, what does it mean here in India specifically? Adidas has revenues of about 1,000 crore rupees plus. Recently it crossed 1,000 crore rupees, and then for Bata has revenues of around 950 crore rupees, again around the 1,000 crore rupee mark. And more importantly, Bata has more than 2,000 stores across the country in over 700 locations. So I really think that what I think Adidas would be looking for would be to leverage Bata's network and presence and penetration in the Indian market, and maybe even come up with that dream product that you're talking about, which brings with you all the bells and whistles of an Adidas shoe, but comes at that Bata price point. But bear in mind, Bata price point is not the typical $999 or $499. Bata's Hush Puppies, for example, cost quite a bit.
Absolutely.
So if Bata's Hush Puppies can come, 5,000 rupee shoes in a Bata showroom, I'm sure you can buy a Bata Adidas for 5,000 rupees. Even at the price level, it's very digestible to get a Adidas. What I would be curious to know, where these people are going to come together on, or Adidas is going to use Bata's showrooms across the country, or is Bata going to premiumize itself by getting an Adidas branded shoe in its portfolio? All of these are possibilities.
Possibilities.
Mouth-watering possibilities.
Realm of speculation at this point in time, because the news that we have is very sketchy. Very preliminary sort of information that is coming out. There's not been any confirmation or denial. In fact, exchanges have, in fact, markets regulator has written to, Bata to ask for a clarification, because the stock is up about 5.6% on the back of that news. So, of course, we'll bring more details as and when they emerge. But let's shift focus to broader markets, and that is the concerns around Chinese economy that are also weighing heavily, not just on the Indian market, but also on global markets all across the world. A series of economic data that has come out from China has exposed the stuttering post-pandemic recovery for the second largest economy of the world. Now, China's economic activity data in July is dampening sentiments for everybody, from retail sales to industrial output to investments. All have failed to match expectations, fueling concerns of deeper, long-lasting slowdown in the growth. Add to it are the worries of deflation, a prolonged lowering in the prices, fueling concerns of further economic slowdown in China. China could be struggling to meet its growth expectations, or target rather, of 5% for the year. Now, Barclays has also cut its forecast for China's 2023 growth in the GDP to 4.5%, citing a faster than expected deterioration in the housing market. Investors so far are unimpressed with the moves of policymakers, and without more fiscal stimulus, recovery seems far-fetched. Karan Maharishi is also joining us on the broadcast, but before we go to Karan, I want to first quickly get a lowdown of what's happening from my colleague Krishna here. Krishna, it's not just a double whammy. If there's a word called like triple whammy, that is a
multiple
problem.
whammies.
Multiple whammies. I think that would be more appropriate for China, and it's not even beneficial for the world anymore. It's not beneficial for anybody. You know, there was a time when we used to discuss how China's hurting economy could be beneficial to India in one way or the other. But all in all, in toto, things don't look good in China at this point at all.
Well, very not the best of times. And the thing is that they say, many economists, Shweta, turn around and say that what were you expecting? Because this was coming. Because those peak double-digit growth rates that China witnessed in the 90s and the early 2000s even. They were going to be a thing of the past. We are in 2023 after all. And especially what they did during the COVID pandemic. They were the first to get affected, and they were the last to
recover.
To remove their restrictions of a very draconian zero COVID policy that just completely shut off the economic activity altogether completely. So in that sense, the hope was that when they reopen, that they will roar back like tigers and lions. And what has essentially happened is that it is the data that's coming out is telling us that that is the opposite of what has happened. Unemployment rate is at 5.3% in the month of July compared to 5.2% in the month of June this year. That's one data. Then came the retail sales growth data. The retail sales growth, slowest pace since December 2022. And also investments in property sector down 8.5%. Property sector has been in pain in China for the last 18 months, ever since the Evergrande controversy. The collapse of Evergrande happened in China, and continues to be a huge pain point, to the point where lesser property is being constructed. Total constructions are down. The price of home sales, the new home prices are down as well. So the property sector is in a world of pain of its own. And bear in mind, China prides itself in how much it can construct and how many houses it sells. And in fact, that counts that as a gross domestic product, the number of houses it makes, not the number of houses it sells. Even the amount of making is down now, and that's the reason why it doesn't want to show these facts. It doesn't want to show these numbers. It doesn't want to show this data. It wants to hide this data. So again, new home prices falling, retail sale, industrial output again down of below estimates, down from last month. It's going down by the month in China, to the point where when it came to data for July, China just put a full stop to it and said that one data we're not going to get out from now on is the unemployment data, especially the youth unemployment data, the age of 16 to 24. The youth unemployment data is over 20% right now. It is at an all-time high, and it was expected to go up even further for the month of July, and that's where they've stopped. They said that we're not going to publish these numbers anymore. Unlike that, there are other numbers that they don't want to publish. Property numbers that they don't publish. They officially want to hide at a time when Xi Jinping comes out and in a speech tells the people of China to be more patient, because
Optimistic.
they call it a quote-unquote the time of economic rejuvenation. That's what Xi Jinping is calling it, and he's asked people to be patient. So which clearly means that it's difficult to even hide the fact that the economy is not doing well for itself. People know it, the government knows it, Xi Jinping knows it, and it's coming out in plain sight, despite the fact that they want to hide so much of their data.
Okay. Before I go to Karan, I also want to quickly come to you, Kranti, before I let you go. Perhaps the last question to you at this point in time. All right, we don't have Kranti, but Karan, essentially alluding to what I was saying earlier, and that is there was a point where China's loss was India's gain. But I think we've gone beyond that point, because we're talking about a largely export-driven economy, an economy that is also responsible for a lot of consumption in the global market. Essentially, China not doing well means there will be a crisis of balance of imports and exports. It's already affecting markets. It's already affecting sentiments all across the world. Not long before this becomes bigger and bigger, what can Chinese government do at this point in time? There is an absence of enough fiscal stimulus, as many economists are pointing out. But what, according to you, can Chinese government do at this point, and how bad are things looking?
Well, first of all, thank you very much, Shweta, for having me. First, I'll talk about the problems that we are facing right now when it comes to China. The real growth numbers, Shweta, might come below 5% this year. So this is a big deal for an economy that is used to growing at 8 to 9%. Now, mind you, Chinese economy was expected to be the world's largest economy before 2030. Now, with these kind of numbers, it looks highly unlikely that would happen. Real estate sector that you were discussing earlier, it contributes around 30% of the Chinese economy, is under a significant threat due to mortgage boycotts and debt defaults. So demand is simply not matching the supply side's optimism at this time. Investment in the sector has declined by over 7% as we speak. Exports, which are the backbone of the economy, have been floundering and have declined by over 20% to the US alone. At the same time, foreign direct investment is declining despite big ticket announcements from German car makers. The only saving grace for China are the retail numbers, but with an average growth of around 3 to 4%, consumer demand, I think, cannot alone rescue the economy, which inherently is not consumption driven. It is not domestic demand driven economy. Deflating, as the Chinese central bank is cutting interest rates despite a healthy looking overall unemployment number of just 5.3%. This means that these numbers are much higher than data suggests. So to my mind, what the Chinese government can do at this point in time is to first try to pacify the Americans and the West, because at the end of the day, Chinese exports are driven by demand in Europe and America. If they continue to talk hawkishly and talk about invading Taiwan, the problem will be even more deeper, and it will be very difficult for Chinese government to get over it.
All right, and let's go through some of these numbers one by one, and I think some of these numbers that are in a sense staggering against China at this point in time. Number one, to begin with, is unemployment rate, which is difficult to hide, also very difficult to contain. When you have a lot of people on streets, and we saw what happened when there was zero COVID restriction, zero COVID policy, which essentially meant a lot of people were disenchanted, they were unhappy, they took to streets, and the government had to come out and remove some of those restrictions, open up its economy eventually. We see a repeat of that, in a sense, with Xi Jinping coming out. It's very unlikely for a communist country or communist government to come on record and try and allay some of those fears. So I think unemployment there remains a major problem. And then apart from that, economically speaking, from consumption to deflation to industrial output, which is at an all-time low, lot of factors that are not working for Chinese government, Krishna.
At this stage, it is difficult for the Chinese government to maintain its growth rate, which is their estimated target, which is 5%. And literally, from the moment they mentioned that as their estimated target, literally everybody across the world, rating agencies and everybody just came out and said, Morgan Stanley, just about everybody came out and said that they're going to find it difficult to come up with that 5% number because quarter on quarter they're not able to meet their targets. So that annual target of 5% too is looking difficult. And here is the problem: you take it further. If they fall down to the growth rates, GDP growth rates of say the US and UK, which is around 2 to 3%, that's when the real problem really begins. The fear for the world is that when China's growth rate halves from 5% to 2 to 3%, that's when the alarm bells will go off completely. For now, we look like it's a slow stumble towards that eventual 2 to 3% growth rate for China because of what you're seeing across on the big macroeconomic indicators for China's growth. One is the unemployment rate. Overall unemployment rate is just steadily climbing up. Last month 5.2%, this month 5.3%. Unemployment rate for the youth specifically, speaking for the 16 to 24 age group was at an all-time high already last month in June, and this month they've officially stopped publishing those numbers. That's a key indicator of what's going on in the economy. And with the fact that the amount of activity literally that's going on in the economy, construction activity is down. Home prices, new home prices are down. People don't want to buy new homes. People, not enough homes are being constructed in the first place. This is not the kind of situation that China has witnessed in over a decade. Ever since its a hectic pace of growth began. So these and economists across the world are already saying that expect more of this. This should not be a surprise. There will be stumbles like this, and many more stumbles is what is expected from China. The fear is for the world economy, for the global economy, is of all these stumbles eventually result in China's overall GDP growth rate number being brought down below that 3% mark. I think that's what we're to watch out for going forward.
And China, which is a significant makes a significant contribution to the global GDP growth rate. Karan, the fear, of course, is that this will have an impact on markets, this will have an impact on exports, and in turn affect economies all across the world. How much, and what should the government at this point in time do apart from the 10-pronged strategy that the communist government did come out with, saying that this is what we're going to do to allay these concerns, we're going to make sure that we fire up growth engines, but that hasn't really happened so far. How concerned are you that the impact on global economies across the world, US to India, or India specifically rather, will be long term, and what can India do to sort of protect itself at this point in time?
Well, Shweta, there's a little that the world can do apart from just praying that China does not just disintegrate. That is a strong statement, but I mean, if you look at what communism is, then communism is built on fair treatment of the labor class. Anything that breeds resentment in the labor class, as we are seeing at this point in time, is a recipe of disaster. The Chinese leadership knows that, and the only way they can suppress the resentment is through an appeal to morality and suffering for the greater good. This is generally not successful, as we have seen during the protests in Eastern industrial SEZs in China due to COVID-related restrictions, as Krishna was alluding to earlier. Once public resentment goes out of hand is when it comes undone, and that starts with lack of employment and consumption restrictions. We have seen similar events unfold in East Germany and Soviet Union before the fall of the Iron Curtain. So I am quite actually I'm just waiting how events will unfold in the near future, because China single-handedly has reduced the global inflation significantly, given the fact that China is the factory of the world. If China is not able to manage its internal affairs at this point in time, the world is actually looking at a very high inflation scenario, and supply chains will not have enough time to reorient themselves, and the fact that we still have very few pockets that can actually challenge or match Chinese capacity. So it's going to be a very difficult phase if China is not able to maintain its domestic politics, and there's a great deal of resentment in China in the near future. That's going to be a big problem for the world.
Hi Karan, so I have a question for you. China obviously fell into deflation last week. So how big of a concern is that? Because from what I understand, deflation is a problem if it is only persistent and it occurs at a time when companies are desperate to sell to consumers who are not willing to buy. But this does not seem to be the case that describes China's economy or the price movements, because after all you are expecting a 4 to 4.5% economic growth, right? So what I'm asking is deflation a temporary stage for China, or do you expect it to prolong?
The problem here is, Suyash, that Chinese economy is an export-driven economy. Now, given the fact that as I was mentioning, Chinese exports to the US alone have declined by over 20%. Now, when you compare the overall decline to US exports, then that's around 7 to 8%. So the Chinese exports are actually declining. And if you look at the aggregate demand equation, then the primary driver of the Chinese economy were exports. Now that exports are declining, and given the fact that, as I was mentioning earlier, that China-US relations are not at their best, and given the Taiwan threat, the Americans are trying to convince their corporates to reorient the supply chains away from China. So that is a big threat for China. Again, if you look at the aggregate demand equation, then the only variable that is actually in favor of China is the retail sales. But even with that is growing at 3 to 4%. So that is not significant enough to sustain the Chinese economy, which is worth almost $19 trillion. And China, again, is not a domestic demand-driven economy. So a 4 to 5% growth rate for an economy that is not yet rich and that is still relatively unorganized as compared to peers in the West or the G7. A 4 to 5% growth rate is not sustainable for China. China has to grow at least 6 to 7% to actually achieve its potential, because the only way communism works is that the economic activity has to continue unabated.
Right. I hope it continues to work that way. For China's downfall is not going to augur well for anybody at this point in time. China contributes, remember, 22% of the global GDP, and the fact that it is a major destination for supply chains of all types of companies who have interest in China means if China doesn't do well, it's going to have an impact on global trade partnerships, have impact on every major economy, developing economy and developed economies around the world. An impact in the markets can already be seen. China feeling the pangs means markets around the world not doing too well at this point. Karan, thanks very much for taking time out for joining us this afternoon. We're going to shift focus for now. ChatGPT may go bankrupt soon. You heard that right. One of the pioneers of AI and the most talked about company this year so far is burning cash. OpenAI, the parent company of ChatGPT, spends roughly $700,000 every day. Now, this is around 5.8 crore rupees to run ChatGPT. The losses are only mounting as per various media reports. In May this year, OpenAI's losses doubled to $540 million ever since it started developing ChatGPT. Who's funding it? The money comes from Microsoft and other recent investors who are covering costs for the ChatGPT, the company, to function from their own pockets. Now, they could turn the tap off very soon if the company doesn't turn profitable. OpenAI projected an annual revenue of $200 million in 2023 and expected to reach $1 billion in 2024, but that hasn't happened so far. In fact, it may go bankrupt by the end of 2024. That, of course, is according to various media reports. We don't know how true they are, but let's quickly discuss ChatGPT, its fortune, and also what its future looks like at this point. Joining us is Nritya Mandappa, who is a partner at 314 Capital. Nritya, thanks very much for taking time out. How true are these reports that ChatGPT may not sustain beyond 2024, or in fact, if it does continue to sustain, it will have to file for bankruptcy?
I I actually have taken quite some time to try and find the sources of this, and it seems to emanate from one report from analysts where they estimate costs of ChatGPT running to $700,000 a day. But all sort of reports around it going bankrupt, etc., are, I think, massive exaggerations. For context, $700,000 a day amounts to about $250 million or so of burn in a year, and with 200 million in revenues across their licensing and subscriptions, etc., actually that burn looks much more reasonable when you look at it at a yearly basis. Above that, and as you mentioned in passing, that Microsoft actually and several others have come together to put over $10 billion in investment into this company, and for a good reason, right? It foundationally shifts the way we can think about leveraging AI into far more daily use cases within each of our businesses. So conversational AI itself with ChatGPT is a form of and a product out of its parent company, OpenAI, one of several products actually that they're building across their models, is foundationally important. And it is one of the biggest leaps forward that we have seen come out of the AI domain in decades. So that in itself, it just is foundational to human progress across this very key portion of technology. So overall, the numbers themselves, when they add up, ChatGPT, according to the 10 billion plus in investment, even at a 700K burn, actually can keep running with its cost offset for over 40 years, to put some context. Plus, with the revenue turning on, however badly they miss those estimates, we see massive demand for licensing of its models across multiple enterprises themselves, and of course, consumers themselves leveraging the subscription format and using ChatGPT in its form. So I think they are massively exaggerated as claims.
Okay. I want to come to revenues, but I also want to understand from you, as far as competition in the market is concerned, OpenAI is competing with Bard, it's competing with Meta's Llama 2, and one of the concerns, of course, being that it is paid, it is proprietary, it is restrictive in nature, where Llama is an open sourced LLM, the large language model that anybody can use to develop commercial products. Therefore, OpenAI has got better competitors, bigger competitors, which may be hurting its fortunes. How true is that?
That is very much true. And for instance, what essentially OpenAI forced was for Google and Meta and all of the other players investing within this space for the last couple of decades to show their hand, and potentially show their hand a little too early. They had the most well-developed programs. They had been, open with what they were developing as products from the get-go. We've only seen Facebook and Google release their products, but it isn't to say that they came out of nowhere overnight. These have all been under production and under development for the past couple of decades. Beginning with Google's, for instance, a giant acquisition of DeepMind several years ago that have led to their sort of, heft with Bard and several other models that they will be putting out. This competition does play a big role. How long any of the resources put out by any of the larger tech companies will remain open source remains to be seen, because as we all know, even OpenAI and ChatGPT itself was open source for a significantly long period of time until ChatGPT 3 and GPT-4 were released, which then went on a subscription sort of basis to offset some of the costs that go into each query. What we do know, however, is this competition is healthy, it is required, and it will foundationally speed up the process of development within this field. Okay. Customers and consumers and enterprises and how they're able to leverage AI will foundationally shift over the next few years. From everything that we know and the vantage point we sit on, there is not an enterprise in the world that hasn't put a SWAT team on figuring out how to leverage any of these models in order to be able to turbocharge their businesses alone, from the largest, including Adobe and what they're doing on the image processing side, all the way to very, very large enterprises across the world, and small enterprises are thinking through how to leverage this best. So overall, I think it's fantastic for the industry. Will the competition ease in? I do believe the market will grow.
I do have one more question from you before I let you go, and this is, you briefly touched upon revenues that OpenAI is generating as a result of its subscription model. Is the revenue enough to sustain its business operations at this point in time? Because the competition, as you rightly mentioned, it's intense out there. You're competing with Meta, you're also competing with Baidu, you're competing with Google, and they have very, very deep pockets. So the $10 million pledged from Microsoft, is that going to be enough? How healthy are the books of OpenAI looking at this point?
So again, this is a developmental and research arm, right? If you would look at, say, Facebook's or Google's sort of AI efforts as a standalone entity, they would be showing similar numbers as to what OpenAI is. And OpenAI, given the kind of heft that another tech giant, Microsoft, has put behind it, we should probably consider them actually as the war of the three tech giants. And each of them are incredibly deep-pocketed to be able to support their specific AI investments and their AI efforts for a very, very long time. So I don't think like OpenAI by itself, standalone, what its revenues are, nobody knows fully. We don't know specifically how healthy their books are. Even the $200 million number that we were talking about was an estimate for 2023 that was publicly put out. We don't know how healthy that is. But actually, the bulk of its revenues actually do come from licenses, where different businesses leverage the AI models that OpenAI has built in order to build their own solutions on top of it. So it isn't just consumers like you and I paying subscription fees to ChatGPT to use it. It's actually large businesses who are plugging directly into the OpenAI models in order to build on top of that. So summary is that there are very deep pockets all around across all of the stakeholders around the table, including behind OpenAI. We see this being very, very long-term, very, very deep-pocketed investments that will happen over the next few years. And I truly believe that the market for something like this is large and wide enough that for three standalone or several more standalone solutions and platforms like this to exist. So from our perspective, extremely bullish about what we can see emerge from this and as layers on top of each of these foundational models.
Nitya, I just have one question left to ask. Is about the fact that there is a global GPU, enterprise level GPU shortage,
Yes.
which seems to also be affecting OpenAI, and of course, of the fact
Yes.
that they are also affected by staffing issues. Apparently, all those good talent from OpenAI is being poached by other tech giants, and they're also losing
Yes.
a lot of employees due to attrition. Are these two factors affecting OpenAI at this stage?
Absolutely. I think they affect any large and fast growing company. We even have colleagues or employees from ChatGPT going on, or OpenAI themselves, going on to build competing entities that goes head to head with OpenAI. This is common parlance for any large business out there. But I would like to make focus on that first portion of that point that you made about the global GPU shortage and overall the massive amount of funding also rushing towards the AI chip ecosystem. Currently, there are, again, 2-3 very large players who have a hold on this, and the amount of investments, similarly, that I would urge you all to look at going into just development of AI chips or into GPU or GPU processing power is just absolutely enormous. So what this is doing, this sort of forward leap in conversational models and LLMs in these OpenAI models have led to an entire ecosystem almost coming forward on the very core hardware and platforms that these models run on. So yeah, we do see and anticipate massive shortages.
All right, so a massive shortage there also on the back of the fact that you have Elon Musk hoping to develop a truth GPT, if that happens at all. But Nitya, thanks very much. It was lovely to have a conversation with you here on Newsline. We hope to get you back. We don't know whether, I think word from Nitya is that we don't know whether books of ChatGPT are any stronger than what they appear, but news of bankruptcy could be far-fetched at the moment. That, of course, is the last word coming in. But I think with that, we've run out of time. Thanks very much for watching.
इंजीनियरिंग कर रहे हैं क्योंकि सभी लोग कर रहे हैं.
Coaching is now starting from grade 3, 4, 5, 6.
होता जाने वाली